Morning, everybody. Happy Thursday. You guys hear me okay? Make sure we get everything up and running here. We've got some pretty good moves this morning to talk about, actually, for a Thursday. And we've been mentioning that we think that markets could get more interesting this week, and I think underneath the surface and maybe on the surface, things have gotten a lot more interesting. So I think that so far has been the right call. So let's get started. Good morning, everybody, or good afternoon. This is our Set the Market morning call. If you've never been here before, please make sure you subscribe to our YouTube channel. That way you are able to get updated in real time when we go live. Also, any videos and ideas and stuff that we upload, you'll get sent to you directly or updated in real time. Also, if you could, as they say, smash that like button, that would be very helpful for us as well, so we can continue to do this show on all the videos, including this one here right now. So, all right, so it's Ticker Thursdays. If you've never been here before, welcome. What that means today is we're going to go through a bunch of tickers that you guys will type in. But of course, we are first going to go through some of the top few things on my notepad, or at least my sheet that was part of a notepad. My watch is talking to me. So let's get started. What I really want to do this morning is I wanted to start off first with basically where 2-year yields are. And I know this is not the kind of thing that the retail community watches too closely, but it's really important to know we've got a weaker dollar this morning versus a whole bunch of currencies on the back of that weaker jobs report. And of course, yields. And I'm going to zoom into the yield chart. What you're looking at here is the yield of the 2-year Treasury note. And I was just talking to my colleague actually a few minutes ago, and this is a trade that we've discussed for some time. This is the yield chart. This is a multi-year chart of the 2-year yield. Like, why would you care about this? Is the question we usually get. And the reality is that when yields start breaking down, and they haven't yet, but they're getting closer and closer, you can see the yields going lower, testing more and more this line here. So at some point, we are going to get yields breaking below, let's say 3.4% in the 2-year tenors or 2-year Treasury yields. And yes, it's going to matter to your stocks. And speaking of stocks, we'll update you guys on that stuff here in just a minute. But you can see, I mean, just optically, right? This is purely just optically looking at a line here. And again, it's a bit of an oversimplification, but you can see that there's plenty of selling pressure that keeps coming in every time 2-year yields go up to about 3.623%, and then they seemingly get clobbered again, or at least selling pressure on yields, buying pressure on bonds. So inverse relationship, right? Yields up, price down, and vice versa. So we're watching this very closely. I think again, sort of the 3.43-ish area on the 2-year yields is going to be where this could get very interesting. So if and when this happens, the trade is basically, if you do futures, then the trade would be to buy 2-year Treasury note futures. That's what I will do, and maybe some SOFR futures, or one can buy an ETF like the SHY ETF, and maybe even do options on that to get some leverage, right? But the point of these macro trades is that they are the real money makers, because from my perspective, when we can put a lot of capital beyond this. I can't put that much capital into one single name stock idea, right? Because it's from a reward to risk perspective and diversification perspective, it doesn't pay to take that much risk on one stock. But I can take a lot of risk on a macro position like this, because it's a little bit lower volatility. And when they trend, they really trend. So you can see, for example, when yields went down back in 2019 into 2020, some of you guys might recall having taken that trade with us. It was orderly in the sense that it wasn't that volatile. It was quick, but it was pretty orderly. And then when yields went back up, then that would have been the sign to basically short Treasury futures, meaning yields go up. And now I think we're getting back to a situation which will be yields going down. They're not going to collapse too much, we don't think, but you can still see yields go down to maybe 2% on the short end is not impossible to think. So we'll see where that goes. So now that I've bored everyone with bond yields, which, however, are critically important for your stock portfolio, let's talk a little bit about the stock market. So one of the things that I think we've been very clear about is the continued outperformance of the energy and material stocks and the underperformance of tech. I have a bunch of charts for you guys here to go through this. So this is just a reminder of this continued. This is the 3-month look back of this divergence. And we've been talking about this now for a year. I'm not sure anyone's really still listened yet, even though now we're seeing it really in a big way. But over the past 3 months, you can see, for example, that the technology sector is down 6%. I thought it was 7, but it's 6-ish. But energy stocks are up 22. Material stocks are up 23. So when you take that spread, it's about 27% of net performance, right? The minus 5-6% on tech plus the plus and the positive 22-23% performance of energy stocks and materials. And so what you get is the spread. Now, what's really perverse about this, and I'd love to get some feedback, by the way, if this is helpful for you guys, but what's crazy about this, and again, if you're a client, we've been talking about this for months and months and months. No one owns the stuff that's up. So energy and materials, no one owns it, right? So most people's portfolio are not up this year because no one owns this stuff. And if they do, they own so little of it that it doesn't matter. There's so much money in tech that really even just a little bit of a money in tech trying to go into energy and materials has the very high probability of doubling, tripling some of these sectors in a very quick way because there's so much money allocated in one part. We've been talking about this now for, again, at least a few quarters, probably more than that. We've been hinting at it for probably a year and a half. And but again, we know people are very slow to make these changes if they ever do. But this is what's happening right now. And so, we've noticed, and we've been telling people about, stocks like Microsoft, which haven't really done anything in 2 years. And they've recently changed their trend. So we had a bullish trend, for example, in Microsoft, which is the green background color. And then that turned into a bearish trend in early January. So we're seeing a lot of this stuff happening. And again, I just would caution people that through the lens of education here, that this is very serious. I personally wouldn't want to miss this. On top of that, if you look at stocks like, I think we talked about this yesterday. If you look at some of these private equity stocks, you look at, for example, KKR, which is Colbert Kravis, or you look at something like Blackstone, right? These stocks are starting to crack pretty hard, and we've mentioned this now for some time. This is where the credit issues start to come to front. Now, so far, the reason for the selling in these stocks isn't necessarily credit problems. It might be more some of the software issues we're seeing. So, software stocks have been seeing a bit of selling. In fact, if I overlay, and that's because these private equity firms invest into a lot of software companies, and there's recently been a lot more concern about software. So for example, if I take the IGV, which is the software ETF, and I overlay it to the private equity, can you guys see the correlation? Give me some feedback on this, folks. This would be helpful to know if you guys, if you care about this stuff, number one, and B, if you can see the correlations. So I'm telling you right now, there's probably not many people anywhere right now that are talking about the correlation between the software stocks I just told you about and these private equity companies. This isn't just charts. Like, this usually takes us a lot of work to find. So I'm giving you the real simple sort of Cliff Notes, right? If you guys remember that in high school, I do. But this is really critical. So you see, it's the same chart for the most part. So again, but this is not the kind of thing that you can listen to, a 25-year-old YouTube channel who tells you about his amazing bullshit trade in some random crypto thing. Like, that actually takes work to understand. Doesn't make me a better person, but it makes us someone who looks at cross-asset correlations through the lens of global markets. So there's a clear correlation there between some of these these private equity company and software. So this is kind of how we measure and map this together. So I would be quite careful on software and private equity right now, because again, there's definitely something going on there. Okay, let's move on to a couple other things. We've talked about the PayPal and that stuff. That stuff's turned to bearish momentum quite a while ago. But I also want to talk about consumer staple stocks, which I know no one really cares about. But I just want to point out, consumer staples, and again, we've talked about this now for some time, they had a major breakout, relative strength and an absolute strength. So you can look at, for example, this very simple chart of consumer staple stocks. They're beating the living daylights out of tech stocks year to date. And then what you can also look at is, for example, let's take a consumer staple stock like Kimberly-Clark, this is purely technical, putting in some really good basis, right? So you can see, Kimberly-Clark, that's the kind of stock we're watching first from a momentum perspective and ultimately maybe from a trend perspective. Thank you guys, I appreciate it. Well, look, the FANG it's the same thing, right? None of these things really are any different. It's all, the correlation is one. Benito, right? You have to understand that when this is why I make such a big deal about understanding the big picture, right? It's nice to know that we can draw a chart, but unless we know what really drives markets, again, all this stuff about how much money is in tech stocks, and you have to correlate that to yields, where we are on the economic cycle. All these things are crucially important, I believe, to make sense of these moves. So whether it's FANG stocks or Max 7 stocks or whatever, it's all the same thing. It's all the same boat. And so, again, this is why this money moving into other parts of the market that I showed you guys here. Hey, one second, let me close this window. Too loud out there. So this is why this is such a crucial chart to understand, right? Where you have not just the 3-month divergence between tech down, energy and materials dramatically up. You can also look at it from a year-to-date perspective. Right? Year-to-date would be this. So year-to-date, energy stocks are up 18%, tech is down 4%. Okay? So we can get to a bunch of different tickers now. Wayne wants to look at URA. He's asking what's up with URA. Well, uranium is essentially, in our view, uranium is nothing more than an energy trade, right? What's up with it is, let's see what's up with it. So what's up with it is this. Let me quickly add it to something here. It's always a question of perspective, right? So let's take URA. So here is, to address your question, Wayne, so uranium, this is now, let's go year to date. Uranium's up 22%. That's what's up with it. You know what's not up 22%? Tech is down 4%. So the question is, what's your time frame? I don't know if your time frame is the next 5 minutes or the next 5 days or the next 5 weeks or 5 months or 5 years. But what's up with it is that uranium is up 22% on the year. Again, beats the living shit out of Mag 7 stocks and tech stocks. So that's what's up with the URA. There's nothing wrong with it. It's just up 22% on the year, right? Again, it depends on your time frame. If you look at uranium from a trend following perspective, so uranium went into a trend following bull cycle in July of last year, and it's so far still up 31%. So again, I don't know what your time frame is. If it's the next 5 days, then of course that's a different time horizon. But the reality is that uranium is up 22, tech is down 5 on the year, right? So I don't think that really changes. Now, be mindful that uranium is quite volatile. So I think maybe that's important to understand. Okay, Apple. So Apple is actually back into a bullish trend. We received a new trend following buy signal just yesterday or 2 days. Yeah, I think 2 days ago. So we've got a trend following signal, which profit target number 1 has been reached. Target 2 is at 282. So that's a trend following signal. We even received a momentum signal on Apple. So this is the short-term momentum. And that one has already reached our free profit target. Now is on a trailing stop. What other tickers do you guys want to go through? Let me know so I can go through a couple other ones. let's see here. So we went through KKR, went through Apple, went through, I think I talked about Microsoft before. We talked about uranium. Wayne would look at uranium. The S&P itself, okay, so let's look at that. So if you look at, for example, the S&P 500, I mean, I keep saying the same thing. This morning, futures are down a little bit. They are down about 75 basis points. So if I were to look at the futures chart, so it takes into account this morning's move. So yeah, so we're basically, the S&P this morning is back to where it was more or less at yesterday's lows, right? Or more or less where it was on January 2nd, or more or less where it was on January 20th, or more or less where it was on like November 4th. It hasn't really done anything. Palantir, right? So I would, again, you know, I see a lot of these fanfare stocks. So Palantir has broken support, right? I think we talked about this the other day. So first of all, again, let's measure and map this here so we can understand this. So we talked about this yesterday or even the day before. So Palantir, for the first time since 2023, has actually changed its trend, right? Trend, not like the next 3 days, but the actual multi-quarter trend. It's a pretty big deal. Doesn't mean the stock is to fall apart from here, but it's no longer a bullish trend. So the trend started back in 2023. The stock then rallied, I think, 1,700%. And now it's no longer a bullish trend. You can see the green background color ended, right? So it's now a neutral or a black background color, which is no longer a bullish trend. Doesn't mean the stock can't go up. It's just currently in a neutral trend. So from a trend following perspective, it's in choppy waters. From a short-term perspective, so if you want to just trade the momentum, if you look at Palantir, if I could type it in properly, you will notice that we received a momentum sell signal all the way back on January 2nd, right? When everyone on TV was still jumping around wearing, you know, Palantir underwear. No one told you to sell the stock then. Momentum did, factually, right? And now it's breaking trend. So that's what's going on with Palantir. Let's look at Conagra, CAG. So Conagra Brands. Conagra Brands from a trend following perspective is now just about coming into a neutral trend. It hasn't yet really turned the corner. It's remained bearish trend, as you can see, for sometimes now going into bullish trend slowly, not quite there yet. From a momentum perspective, that's the shorter term stuff, right? We've had a momentum buy signal on the 22nd of January, and so far the stock is up 13%. Okay. Biogen, let's see, BIIB. So Biogen continues, remains in a bullish trend. So that's, again, the trend following thing. And from a momentum perspective, so the shorter term stuff, we have new fresh momentum as of the 30th of January. I think Biogen reports or reported earnings. You got to be very careful with these stocks, guys, because these are biotech stocks. Oh yeah, they report numbers. They report numbers tomorrow. So I would never touch a stock like that from a trading perspective. Swing trading through earnings, no way. From an investment perspective, that's fine, but not from a trading perspective. Copper miners, let's see, COPX. Copper miners remain bullish trend, right? So again, you can see that the bullish trend started in August of last year. So far, these stocks are now up about 100%. From a short-term perspective, COPX, these are momentum. We still have bullish momentum. Hasn't changed. And in fact, that bullish momentum started in November of last year. And so far, copper miners are up 36%. Okay. All right, listen, we are at the 15-20 minute mark here. I hope this was helpful for everybody. We are going to move into the third and final day of our winter boot camp here today in just about an hour and a half, hour and 40 minutes. So we look forward to seeing all of you guys there. We're going to talk about income trades today. We're going to go a lot more through our process in the third day of the boot camp. It's going to be a good day, and we're going to talk a lot more about the rotation that we've seen here that I've alluded to a little bit here to this morning as well. So see you guys all in the boot camp, hopefully. Have a great day. And next week I am out. I am out on skiing, snowboarding, family vacation. I will not be doing Set the Market, but if you are a member, of course, you'll receive our trade ideas throughout the week as usual. Have a great start to the day, and we'll see you guys in the boot camp in an hour and a quarter, hour and a half or something like that. Thanks, folks. And thank you, James, and Daily Trader, and Wayne, and everyone else. Much appreciated. See you guys soon.